federal long-term capital gains tax. Right now, the rates are actually, from a historical standpoint, fairly low. So right now, you're either giving 15% or 20% of the gain that you made back to the Fed in the form of capital gains tax. Prior to 2001, that rate was actually 28%. Depending how midterm elections shake out in November, if things move back towards the left, and if we elect a Democratic president in the next election cycle, and I don't care what political party you are, but these are just historically what happens, I'd say these rates are more likely to go up than to go down. Both President Obama and Hillary Clinton on the campaign trail were talking about raising the rate to 28%. That will mean more of your clients will actually end up doing 1031 exchanges because they won't want to pay these higher rates to the federal government. So, yeah.
I have a question. I have a client that has plots at Rose Hill and 2 in Hawaii. How does she do a 1031? Is somebody exchanging plot to plot?
You can actually sell your cemetery plots. If she wanted to sell all 3 cemetery plots and combine the money from the 3 sales and go put it into a condo, she can do that. It's considered real estate. Typically with grave plots, it's similar to a co-op. Most cemeteries, they don't actually give you a fee simple. I mean, there's not usually a deed that's recorded. You get the equivalent of stock shares like in a co-op.
Yeah, she has a thing, yeah.
But co-op shares are considered real property from an IRS perspective.
So basically, during a 1031, how, if she's got 3 plots, and she wants to exchange for a condo?
Yep.
For 1031?
She can do that. So if I buy all 3 plots from her, I give her $50,000 for those 3 plots, she could take that $50,000 and go buy a condo if she wanted to. So for all of you that have exes that you bought plots with them and now you don't like them anymore because you're divorced, you can sell off his plot and go do an exchange with him. All right. So back to the tax rates. So to the Fed, you're generally looking at giving roughly 1/5 of your overall gain back to the government in some form of tax or another. You get into this higher rate of 20% when your taxable income is more than $428,000 a year if you're single, or $479,000 a year if you're married. Most of my clients don't make that much money, right? But just by selling your piece of real estate, you are probably putting yourself into a tax bracket that you didn't expect to be in. Most people don't realize, if I'm a dentist and I made $200,000 last year as a dentist, but now I'm making $900,000 from the sale of my property, I made $1.1 million. So I'm now paying this higher rate of 20%. So a lot of times, particularly here in California, I find that investors that sell and cash out end up paying the higher rate of 20%. Now the state also wants to get its chunk of the pie, and the state of California takes anywhere from 9.3 to 13.3% of the gain. Again, highest ordinary income tax of any state in the country. We like to be number 1 or number 50. You really want to look at it. So if you combine 20% and 13.3%, you're now at 1/3 of your overall gain going back to the government in some form of tax or another. Now there is also a healthcare surtax that comes into play. Now what the heck does healthcare have to do with real estate? I don't have any clue. But in 2008, when President Obama reformed healthcare, we had to find a way to pay for healthcare reform. Taxing investments is one of the ways that we do that. So investment real estate is included in that. So you get to give another 3.8% of your gain if your AGI, if your adjusted gross income, is above 200 if single or 250 if you're married. So another 3.8%. Next year, with tax reform being passed, next year this rate stays at 3.8%, but these thresholds drop to $0. So if you make more than $0, you get to pay another 3.8% starting next year. Yeah, so everyone will be paying a healthcare surtax. And then
everyone? Healthcare surtax? What is that for?
To pay for healthcare reform. So remember in 2012 when President Obama, some people would call it Obamacare, universal health care basically. Well, in order to pay, you got to find a way to pay for universal health care. So the way that the federal government did it is they decided to tax investments. And, you know, stocks, bonds, mutual funds, and investment real estate. So, so you get to give another 3.8% of your gain to the government.
And that is also on rents collected, like let's say you have 30,000 a year
No.
from one
Nope.
investment property, so no
Not on that.
3.8.
That's just ordinary income. You're going to pay
Ordinary
ordinary
income.
income tax on that, which is much higher, unfortunately. And last but not least, my personal favorite, depreciation recapture. You guys all familiar with what depreciation is?
Yeah.
Okay,
Yes.
so anytime you own investment real estate, unless you own vacant land, you should be depreciating your real estate on your tax returns. Well, if you sell, you cash out, and you don't exchange, the government says, okay, remember all that depreciation you've taken over the last 10 years that you've owned this property? Well, I want 25% of that depreciation back. So generally, when you blend all of these rates, the Fed, the state, the healthcare, the depreciation, in California, you're generally looking on the low side of probably 30% of your gain. On the high side, 42, 43% of your overall gain going back to the government in some form of tax or another. So if this client sells for $1 million and he thinks he's putting $1 million in his pocket, he's going to get what we call the April surprise. April because that's when you file your taxes, right? And you'll get a tax bill to the tune of roughly $400,000. So these rates are the number one reason why I am so busy right now, why we have so much exchange business, because investors don't want to pay all of these taxes. The government allows you to keep all of this as long as you sell this for $1 million and you go do a 1031 exchange and buy something for $1 million or more. So that's the rule of thumb. You need to buy for equal or greater value if you want to defer all of these taxes. Yeah.
Can't you purchase properties? And
Absolutely.
I did that.
Yeah.
I sold a house out here and then I bought more properties.
Yeah, I mean, a lot of our clients are doing that. They're starting to diversify their real estate portfolios through 1031 exchanges. So, an example like yours, you sell something for $1 million, you go buy 4 $250,000 properties, perfectly fine, not a problem at all. A lot of people use them to diversify, or do the opposite. You might get sick of owning 4 properties and at some point say, you know what, I want to sell off all 4 of these, combine the money, and put it into an office building. You can do that also. You can consolidate your real estate portfolio through an exchange. Yeah.
Is there any difference for a foreign person to do this in the U.S.?
So foreign investors definitely qualify for 1031 exchanges. Doesn't matter where you're from, you can absolutely do an exchange. For foreign investors, though, they have to have a U.S. tax ID. Have to. The reason being, when you do a 1031, you have to have a company like ours. We're an exchange accommodator. I should probably explain what I actually do for a living. A lot of times I leave these classes and people just think that I like to educate on 1031 exchanges. That doesn't make any money. Anytime you do an exchange, you have to have a neutral third party. It's called a qualified intermediary. We have to prepare documents for the property that's sold and for each property that's purchased. And we also have to hold your money in between the time you sell property A and go out and buy property B. In order for us to open up an individual segregated bank account for you, we have to have your tax ID number. You cannot open a checking account at a bank in the United States without a U.S. tax ID number.
Would you recommend to a wealthy individual to do this under his individual income tax, or would you recommend incorporating it?
Right.
It depends. So when tax reform was passed, the corporate tax rate was lowered to the lowest rate since like 1938. So I got a ton of phone calls after tax reform passed of people saying, should I own all my real estate in my corporation now? Should I set up a corp and own all my real estate in the corporation because the tax rates are actually lower than owning it in a trust or whatever the case may be? It really just depends on the advice of your CPA. I mean, I've seen a lot of people will put their properties into LLCs because they're worried about lawsuits or whatnot. Particularly commercial property owners, I find, put their properties oftentimes into LLCs. I would recommend at least have it in your trust in order to avoid probate. You definitely don't want to die, own this property as an individual, and then have your heirs have to go through the probate process to get their hands on your real estate. It's a big nightmare. But a lot of our clients are using exchanges as a way to estate plan, to plan for the future. And so one of you guys brought up, dying earlier. Should I hold my property until I die? Yeah, you absolutely should. Because when you die, your heirs get a step up in basis in the properties that you own. Okay, you want me to explain what that means?
Yeah.
All right.
Do you have business cards?
Oh, yeah. Okay. And I've got, on the ground here, I've got little flyers too.
Okay.
That have my information printed on the front. So I'll hand those out in just a second. Or if you need to scoot out, that's fine. I'll toss you one.
You ever talk about the term boot money?
Yeah, I'll talk. Did you have some boots?
My wife